In this video, candidates, you're going to be looking at one of the most amazing standards in IFRS, and it is IFRS 15. This standard is made up of 129 paragraphs, so we're going to be here for some time, and we have 64 pages that we need to cover altogether. Please, if you want to join us, just feel free to go grab a cup of tea, then sit down as we go through and interpret the standard. We are going to read word by word and analyze the information as we find it important for us to look at it. Now let us see, what are we looking at? As I've already stated, we are looking at IFRS 15, which is a revenue from contracts with customers. In April 2001, the International Accounting Standard Board adopted International Accounting Standard 11 construction contracts and International Accounting Standard 18 revenue, both of which had originally been issued by the International Accounting Standard Committee in December 1993. The International Accounting Standard 18 replaced a previous version of revenue recognition that was issued in December 1982. International Accounting Standard 11 replaced part of International Accounting Standard 11 accounting for construction contracts that was first issued in March 1979. So this gives us a background in terms of those two standards, which is International Accounting Standard 18 revenue as well as International Accounting Standard 11 accounting for construction contracts. Then what happened in December 2001, the board issued SIC 31 revenue better transaction involving advertising services. The interpretation was originally developed by the Standard Interpretation Committee of the IASC to determine the circumstances in which the seller of advertising services can reliably measure revenue at the fair value of advertising services provided in the better transaction. In June 2007, the board issued IFRS 13 Customer Loyalty Program. The interpretation was developed by IFRS Interpretation Committee, the Interpretation Committee, to address the accounting by entity that grants awards credit to its customer. So now you'll understand why we see this SIC 31 as well as IFRS 13 as we go along in our interpretation of the standard. It is important to take note that it is very important for you to keep in mind that the standards are important for the analysis of the revenue. In July 2008, the board issued IFRS 15 agreement for the construction of real estate. The interpretation was developed by the Interpretation Committee to apply to the accounting for revenue and associated expense by entity that undertake the construction of real estate directly or through subcontractors. Then when we look in January 2009, the board issued IFRS 18 transfer of assets from customers. The interpretation was developed by the Interpretation Committee to apply to the accounting for transfer of item of property, plant and equipment by entity that receives such transfer from their customers. Then in May 2014, the board issued IFRS 15 revenue from contracts with customer, together with the introduction of the topic 606 into the Financial Accounting Standard Board accounting standard codification. IFRS 15 replaces International Accounting Standard 11, International Accounting Standard 18, IFRS 13 and IFRS 15, as well as IFRS 18 and SIC 31. IFRS 15 provides a comprehensive framework for recognizing revenue from contracts with customers. So this is very important for you to understand that when in 2014 IFRS 15 was introduced, it was replacing all the standards that you see, and the standards is International Accounting Standard 11, 18, IFRS 13, IFRS 15, IFRS 18, as well as SIC 31. So now when you look at IFRS 15, think of it as a replacement of all the standard. It is for that reason we have 64 pages, because in that 64 pages we need to cover everything that encompasses of what you previously known or that was previously documented in this standard that is replaced by IFRS 15. Then in September 2015, the board issued effective date of IFRS 15, which deferred the mandatory the monetary effective date of IFRS 15 to 1 January 2018, right? So the effective date of the standard was 1 January 2018, so that means the financial statements of the company that start from 1 January 2018, they had to therefore ensure that they are presenting their revenue in line with the new standard. In September 2016, the board issued clarification to IFRS 15 revenue from contracts with customer, clarifying the board's intention when developing some of their requirements in IFRS. The amendment do not change the underlying principles of IFRS 15, but clarify how this principle should be applied and provided additional transactional relief. So in April 2016, there were clarification on the principles that are in IFRS 15. However, it is important, candidate, to understand this was just clarification. They were not changing any of the principles. So the principles remain the same, just the additional example and clarification that was provided by the board. And then in May 2017, the board issued IFRS 17 insurance contracts, which permits an entity to choose whether to apply IFRS 17 or IFRS 15 for specified fixed fee service contracts that meet the definition of insurance contracts. So now we know that there's also a new standard, and this standard was issued in May 2017, and it regards to the insurance contracts. And also it is important, candidate, to know that the entities or the companies were given option to choose whether they apply IFRS 17 or IFRS 15 on specified fixed fee service contracts. Other standards have minor consequential amendments to IFRS 15, including IFRS 16 leases, which was issued in January 2016, and amendment to reference of the conceptual framework, which was issued in March 2018. Now again, when you're looking at the table of content, we will see that we have a lot of information from objective, meeting the objective, scope, recognition, identifying contracts, combination of contracts, contracts modification, identifying of performance obligation, satisfaction of performance obligation, the measurement, determining transaction price, allocation of the transaction price to performance obligation, the changes in the transaction price, the contract's cost, incremental cost of obtaining the contract, cost to fulfill the contract, amortization and payment. There's a presentation and disclosure on contracts with customer, significant judgments in the application of the standards, asset are recognized from the cost to obtain or fulfill the contracts with customer, and then there is practical expedient, the appendices and the defined term. Also, when you're looking at B, there's applicable guideline or guidance. When you're looking at Appendix C, effective dates and transition, then we're looking at dates, amendment of other standards, approval by the Board of IFRS 15 issued in May 2015, and approval by the Board of Amendment to IFRS 15. Then effective date is written here, and the clarification of IFRS 15 revenue from contracts with customer issued in April 2016. Now, as we're looking on the first part for the this illustrative example, appendixes, amendments, to guidance on other standards. Then there is basis for conclusion, dissenting opinion, appendixes to the basis for conclusion, and there's a comparison of IFRS 15 on topic 606, amendment of basic of basis for conclusion on other standards. Now, as we move down, then we start with the IFRS 15 is the International Financial Reporting Standard. 15, revenue from contracts with customer. It sets out in paragraph 1 to 129 in appendix A to D, as I've already explained. All the paragraphs have equal authority. Paragraph in bold type state the main principle. Terms defined in the appendix A are in italics the first time that it appears in the standard. Definition of the other terms are given in the glossary for International Financial Reporting Standard. The standard should be read in the context of the objectives and the basis for conclusion, the preface of the IFRS standard, and the conceptual framework for financial reporting. International Accounting Standard 18, accounting policies, changes in accounting estimates and errors provide basis for selecting and applying accounting policies in the absence of explicit guidance. So what is important here from what we see is it's important to take note that when we're talking about this information, it will be on 1 to 129 paragraphs and appendix A to D. So all the information that is sitting in what is stated here, it is important for you to take note of them, and we'll go through it together. Now, first thing first, what is the objective of the standard? Why do we have the standard in place? So the objective of the standard is to establish the principles that the entity shall apply to report useful information to the users of financial statements about the nature, amount, timing, and certainty of revenue and cash flow arising from contracts with customer. So basically, it encompasses how do we go about the accounting treatment of the revenue in the books of the company. Meeting the objectives. To meet the objective for the in the paragraph 1, the core principle of the standard is that an entity shall recognize revenue to predict the transfer of promised goods and or services to customer in the amount that reflects the consideration to which the entity expects to be entitled in exchange for the goods or services. So now, when this revenue is recognized, it should be at an amount that the entity is expecting to be entitled for in exchange of the goods or services that is provided to the third party. In this case, the third party is what we normally call the customer. When you look at paragraph 3, an entity shall consider the terms of the contract and all relevant facts and circumstances when applying the standard. An entity shall apply the standard, including the use of any practical expedients consistently to the contract with similar characteristics and similar circumstances. So what is important when you're looking at paragraph 3 is that the term of the contracts need to be read and understood by the entity or the business that is entering into the contract, and also any practical expedient needed to be applied consistently to the contracts of similar characteristics and the circumstances. So it is very, very important that the contract is understood by the client, or is understood by the entity, and any practical expedients that are applicable need also to be applied consistently on the similar characteristics or similar circumstances. Paragraph 4, the standard specifies the accounting for individual contracts with customer. However, as practical expedient, the entity may apply the standard to a portfolio of contracts or performance obligations with similar characteristics, and the entity reasonable expects that the effects of the financial statements of applying the standard to the portfolio would not differ material from applying the standard to the individual contracts or performance obligation within that portfolio. When the accounting for the portfolio, an entity shall use estimates and assumptions that reflect the size and the composition of the portfolio. Then when we're looking at the next part, it is the scope, and when we're looking at IFRS, at paragraph 5, an entity shall apply the standard to all contracts with customer except, so there are exceptions in terms of which item or contract where IFRS 15 should not be applied. And when we're looking down, it is said that the lease contracts, or what we call IFRS 16 leases, contracts with customer are within the scope of IFRS 17, right? However, an entity may choose to apply the standard in the insurance contracts that have their primary purpose the provision of services for a fixed fee in accordance with paragraph 8 of IFRS 17. So it is very important that candidates understand that if there's a fixed fee that is received on the insurance contracts, then the company has the right, or they can choose whether they apply IFRS 17 or they apply IFRS 15. However, with regard to leases, they should not apply IFRS 15 for the leases. However, they should apply IFRS 16. Financial instrument and other instrument rights to the obligation within the scope of IFRS 9, financial instrument, IFRS 10, consolidated financial statement, IFRS 11, the joint arrangement, International Accounting Standard 27, separate financial statement, as well as the International Accounting Standard 28, which is investment in associates and the joint venture. and a non-monetary exchange between entities in the same line of business to facilitate sales to customer or potential customer. For example, the standard would not apply to a contract between two oil companies that agree to an exchange of oil to fulfill demand from their customer in different specified location on a timely basis. So if anything is non-monetary exchange between the entities, then this standard should not be applied, or IFRS 15 rather should not be applied. And the example is given on the oil companies. For example, one oil company here in South Africa may say that we are making an exchange with other company that is selling oil in Nigeria. So by doing that, then the standard says no, because this is not monetary exchange, please do not apply the standard. So it has any item needed to have monetary term. An entity shall apply the standard to a contract other than the contracts listed on paragraph 5. So paragraph 5 has exceptions only if the counterparty to the contract is a customer. A customer is a part that has contracted with an entity to obtain goods or services that are an output of the entity's ordinary activity in exchange for the consideration. A counterparty to the contract would not be a customer if, for example, the counterparty has contracted with the entity to participate in an activity or process in which parties to the contract share in the risk and the benefit that results from the activity or processes, such as developing an asset in the collaboration arrangement rather than to obtain output of the entity's ordinary activities. So, what is important to take note here, candidates? It is important to understand that there should be an output, and this output should be the ordinary activity of the company that is selling that output. And if the risks are shared, therefore, that cannot be considered as a revenue in line with the IFRS 15. Paragraph 7. A contract with customer may be partially within the scope of the standard and partially within the scope of standard listed in paragraph 5. So what does that mean? It means that partially we can have revenue that can be recognized under IFRS 15 and the other part should be recognized under IFRS 17. So that's what this part is saying. In the other standard, specify how to separate and or initial measure one or more part of the contract. Then an entity shall first apply the separation and or measurement requirement in those standard. An entity shall exclude from the transaction price the amount of the part or parts of the contract that are initially measured in accordance with other standard and shall apply paragraph 73 to 86 to allocate the amount of the transaction price that remains, if any, to each performance obligation within the scope of the standard and to any other part of the contract identified in paragraph 7b. If the other standard do not specify how to separate and or initial measure one or more part of the contract, then the entity shall apply the standard to separate and or initial measure the part of the contract. And in paragraph 8, the standard specifies the accounting for the incremental cost of obtaining the contract with the customer and for the cost incurred to fulfill the contracts with the customer if those costs are not within the scope of another standard. Then you need to look at the paragraph 90 E1 as well as 104, which obviously talks of the incremental cost. The entity shall apply those paragraphs only to the cost incurred that relate to a contract with customer or part of the contract that is within the scope of the standard. Now we're going to look at the recognition, because it's important to understand when to recognize the revenue. Then identifying the contract. So first part, we need to identify the contract. An entity shall account for a contract with customer that is within the scope of the standard only when all the following criteria are met. It is very important to understand that all the criteria should be met. The parties to the contract have approved the contract in writing, orally, or in accordance with other customer business practice and are committed to perform their respective obligation, right? So there should be approved contracts and each party is committed to perform their respective obligation. The entity can identify each party's right regarding the goods or services to be transferred. The entity can identify the payment terms for the goods or services to be transferred. Right, so now the payment terms should be available. The contract has commercial substance. The risk, timing, or amount of the entity's future cash flows is expected to change as a result of contract. It is probable that the entity will collect the consideration to which it will be entitled in exchange for the sale of goods or services that will be transferred to the customer. In evaluating whether the collectability of the amount of consideration is probable, an entity shall consider only the customer ability and intention to pay that amount of consideration when it is due. The amount of consideration to which the entity will be entitled may be less than the price stated in the contract, and the consideration is variable because the entity may offer the customer a price concession. A contract is an agreement between two or more parties that create enforceable rights and obligation. Enforceability of the rights and obligation in a contract is a matter of law. Contracts can be written, oral, or implied by an entity's customer business practice. The practice and the processes for the establishing contracts with customer vary across legal jurisdiction, industries, and entities. In addition, they may vary within the entities. For example, they may depend on the class of the customer or the nature of the promised goods or services. An entity shall consider those practice and processes in determining whether and when an agreement with the customer creates enforceable rights and obligation. So now it is very important to understand what is a contract. A contract, it is something legally and it can be oral, implied, or even written. And it is very important for the entity to understand at what point do the customer and the company have the rights and obligation. So when talking about the rights, so we're saying the right of the customer to receive the product as well as the right of the entity to receive the money for the product delivered, and the obligation for the customer to pay for the product, as well as the obligation of the company to deliver the product or service to the customer. So it has to be also considered whether now there is an enforceable right and obligation in both parties with regard to the contract, whether it was oral, implied, or written. And also, we need to understand that what are the trends or practice of the company when it comes to contract, and when do they know whether now this contract is valid or not valid. And then paragraph 11, some contracts with customer may have no fixed direction and can be terminated or modified by either party at any time. Other contracts may automatically renew on a periodical basis that is specified in the contract. An entity shall apply the standard to the duration of the contract, that is contractual period, in which the parties to the contract have present enforceable rights and obligation. For the purpose of applying the standard, a contract does not exist if each party to a contract has unilaterally enforceable right to terminate or a wholly unperformed contract without compensating the other party. So if there is an ability of one party to sit down and say they want to cancel the contract without the other party being able to get any compensation for the contract that has been cancelled. Therefore, it means that there is no contracts or valid contracts. A contract is wholly underperformed if both the following criteria are met. It wholly unperformed if both the criteria are met. The entity has not yet transferred any promised goods or services to the customer, and the entity has not received and is not yet entitled to receive any consideration in exchange for the promised goods or services in a contract. Paragraph 13. If a contract with customer meets the criteria in paragraph 9 at a contract's inception, an entity shall not reassess those criteria unless there is an indication of a significant change in facts and circumstances. For example, if the customer's ability to pay the consideration deteriorates significantly, an entity would reassess whether it is probable that the entity will collect the consideration to which the entity will be entitled in exchange for the remaining goods or services that will be transferred to the customer. So, what are we saying? We're saying there is no reassessment after the contract has been initially recognized unless there is a deterioration which is significant, that indicates that now the customer will not be able to pay for the goods or services that they have received. If a contract with customer does not meet the criteria in paragraph 9, an entity shall continue to assess the contract to determine whether the criteria in paragraph 9 has subsequently been met. So now what are we saying is that there should be continuous reassessment of the contract to determine whether the criteria in the paragraph 9 has been subsequently met after it was not met previously. When a contract with customer does not meet the criteria in paragraph 9 and an entity receives consideration from the customer, the entity shall recognize the consideration received as revenue only when either of the following events have been met. So now what are we saying? We're saying that there is a consideration that has been received from the customer. However, the criteria that we have in paragraph 9 have not been met. So what does that mean? It means there is no valid contract. So now what then how should the entity recognize the revenue in that instance? So the entity has no remaining obligation to transfer goods or services to the customer, and all or substantially all of the consideration promised by the customer has been received, but the entity is non-refundable. The contract has been terminated and the consideration received from the customer is non-refundable. So the consideration should be recognized on the basis that it is non-refundable. So for non-refundable income received, then a revenue should be recognized in that instance. Then paragraph 16, an entity shall recognize the consideration received from customer as a liability until one of the events in paragraph 15 occurs or until the criteria in paragraph 9 are subsequently met. Determining on the facts and circumstances relating to the contract, the liability recognized represent the entity's obligation to either transfer goods or services in future or refund the consideration received. In other case, the liability shall be measured at an amount of consideration received from the customer. Combination of contracts. So that starts in paragraph 17 and we're going to look at it in detail. An entity shall combine two or more contracts entered into at or near the same time with the same customer or related parties of the contracts and account for the contract as a single contract if one or more of the following criteria are met. The contracts are negotiated as a package with a single commercial objective. The amount of consideration to be paid in one contract depends on the price or performance of the other contract, and the goods or service promised in the contracts are a single performance obligation in accordance with paragraph 22 to 30. So now, what do we do now? We have a contract which is dependent on the other one. So in that case, now it is recognized as a single contract, obviously provided that one or more of the criteria below have been met. Now 18, contract modification. A contract modification is a change in the scope, or price, or both of a contract that is approved by the parties to the contract. In some industries and jurisdiction, a contract modification may be described as a change order, a variation, or an amendment. A contract modification exists when the parties to a contract approves a modification that either creates new or change existing enforceable rights and obligation of the parties to the contract. A contract modification could be approved in writing by oral agreement or implied by customary business practice. If the parties to the contract have not approved a contract modification, an entity shall continue to apply this standard to the existing contract until the contract modification has been approved. Then paragraph 19, a contract modification may exist even though the parties to a contract have a dispute about the scope or price or both of the modification of parties have approved a change in the scope of the contract but have not yet determined a corresponding change in price. In determining whether the rights and obligations that are created or changed by the modification are enforceable, an entity shall consider all relevant facts and circumstances, including the terms of the contract and other evidence. If the parties to the contract have approved a change in the scope of the contract but have not yet determined the corresponding change in price, an entity shall estimate the change of the transaction price arising from modification in accordance with the paragraph 50 to 54 on estimating variable consideration, in paragraph 56 to 58 a constraining estimate of the variable consideration. And then when we move to paragraph 20, an entity shall account for the contract's modification as a separate contract if both of the following conditions are met. So when do we account for contract modification as a separate contract? If both of the following conditions are met. So both of the conditions need to be met in order for the contract modification to be considered as a separate contract. The scope of the contract increased because of the addition of promised goods or services that are distinct. So there's additional promises to the contract. The price of the contract price increased by an amount of consideration that reflects the entity's standalone selling price of the additional promised goods or services, and any promised adjustment to that price to reflect the circumstances of the particular contract. For example, an entity may adjust the standalone selling price of an additional good or services for a discount that the customer receives, because this is not necessary for the entities to incur the selling related costs that it would incur when selling similar goods or services to a new customer. So now what are we looking at? If there's an increase in the promise and also the contracts increase an amount of consideration that reflect the entire standalone selling price, then if both are met, then the contract should be recognized as a separate contract. If a contract's modification is not accounted for as a separate contract in accordance with paragraph 20, an entity shall account for the promised goods or services not yet transferred at the date of contract modification. The remaining promised goods or services in which of the following way is applicable. An entity shall account for the contract modification as if it were a termination of the existing contract and a creation of the new contract. If the remaining goods or services are distinct from the goods or services transferred on or before the date of the contract. Modification. The amount of consideration to be allocated to the remaining performance obligation or to the remaining distance goods or service is a single performance obligation identified in accordance with paragraph 22b of the sum of the consideration promised by the customer, including amount already received from the customer that was included in the estimate of the transformation price and that had not been recognized as revenue, and the consideration promised as part of the contract's modification. Then when we look at B, an entity shall account for the contract's modification as if it were a part of the existing contract if the remaining goods or services are not distant and therefore form part of the single performance obligation that is partially satisfied at the date of the contract's modification. The effect that the contract's modification has on the transaction price and on the entity's measurements of progress towards complete satisfaction of the performance obligation is recognized as an adjustment to revenue, either as an increase in the reduction of revenue at the date of the contract's modification. That is, the adjustment to revenue is made on the cumulative catch-up basis. C, if the remaining goods or services are a combination of items, and then entity shall account for the effect of the modification on the unsatisfied, including partial unsatisfied performance obligation in the modified contract in a manner that is consistent with the objectives of the paragraph. Identifying performance obligation. At the contract's inception, an entity shall assess the contract or service performed in a contract with the customer and shall identify as a performance obligation each promised good to a customer. A series of distant goods or services that are substantially the same and has the same pattern of transfer to the customer. A series of distance goods or services has the same pattern of transfers to the customer if both of the following criteria are met. Each distance goods or services in the series that the entity promised to transfer to the customer would meet the criteria of paragraph 35 to be performance obligations satisfied over time. And in accordance with paragraph 39 to 40, the same method should be used to measure the entity's progress toward complete satisfaction of the performance obligation to transfer each distance good or services in the series to the customer. Promise in the contract with customer. A contract with customer generally explicitly states the goods or services that an entity promised to transfer to the customer. However, the performance obligation identified in the contracts with the customer may not be limited to the goods or services that are explicitly stated in the contract. This is because a contract with customer may also include promises that are implied by an entity's customary business practice, published policies, and a specified statement if at the time of entering into the contracts, those promises creates a valid expectation of the customer that the entity will transfer goods or services to the customer. The performance obligation do not include activities that an entity must undertake to fulfill the contracts unless those activities transfer goods or services to a customer. For example, a service provider may need to perform various administrative tasks such as set up contracts. The performance of the task does not transfer the service to the customer as the tasks are performed. Therefore, the setup activities are not performance obligation. Distance goods or services. So now what are the distance goods and services? We need to understand that. Depending on the contracts, promised goods or services may include but not limited to the following: the sale of goods produced by the entity, for example, inventory from the manufacturer. So the sale of goods, and the next one, the resale of goods purchased by the entity, for example, merchandise of the retailer. Resale of right to good or service purchased by the entity, for example, ticket resold by the entity acting as a principal as described in the paragraph. Performing a contractual agreed upon task to the customer. So any contract agreed upon task to the customer, providing service, stating ready to provide goods or services, for example, unspecified updates to software that are specified on when it is available basis, or of making goods or service available for a customer to use as and when the customer decides. Providing a service of arranging for another party to transfer goods or services to a customer, for example, acting as an agent on another party as described in paragraph B34 to B38. Granting right to customer or services to be provided in the future that a customer can resell or provide to its customer. For example, an entity selling a product to a retailer promises to transfer any additional goods or services to an individual who purchased the product from the retailer. Constructing, manufacturing, or developing an asset on behalf of a customer, or granting licenses. And granting option to purchase additional goods or services when those options provide a customer with material rights as described in paragraph B39 to B43. So material right is important that those additional goods that are promised to be provided are material or has material right. A good or service that is promised to a customer is distinct if both of the following criteria are met. The customer can benefit from the good or service either on its own or together with other resources that are readily available to the customer, and the good or service is capable of being distant. And the entity promised to transfer the goods or service to the customer is separately identifiable from other promise in the contracts. That is, the promise to transfer the goods or service is distinct within the context of the contract. A customer can benefit from a good or services in accordance with paragraph 27A if the goods or service could be used, consumed, or sold for an amount that is greater than scrap value or otherwise held in a way that generates economic benefit. For example, for some goods or services, the customer may be able to benefit from goods or services on its own. For other goods or services, a customer may be able to benefit from the goods or service only in conjunction with other readily available resources. A readily available resources is a good or service that is sold separately by the entity or another entity, or resources that the customer has already obtained from the entity, including goods or services that the entity will have already transferred to the customer under the contract or from other transaction events. Various factors may provide evidence that the customer can benefit from a good or service either on its own or in conjunction with other readily available resources. And then there is an example that we have that we're gonna look at. And then we are saying, for example, the fact that the entity regularly sell goods or service separately would indicate that the customer can benefit from the goods or service on its own or with other readily available resources. So the example, it could be the charger as well as the phone. So the charger can be sold separately from the phone. So that means it can be taken into account as a separate performance obligation. Then we're looking at paragraph 29. So what do we have in paragraph 29 that is so appealing or interesting? When you're looking at paragraph 29, in assessing whether an entity promised to transfer goods or services to the customer are separately identifiable in accordance with the paragraph 27b, the objective is to determine whether the nature of the promise within the context of the contract is to transfer each of those goods or services individually, or instead to transfer a combined item or item to which the promised goods or services are input. Factors that indicate that two or more promise to transfer goods or service to a customer are not separately identifiable include, but not limited to, the following. So now we're looking at the factors that confirm that the goods or service is not separately identifiable. So, and then it's not limited to what we'll be looking at, but those are the indication that you should look in any of the contracts. The entity provides significant savings of integrating the goods or services with other goods or services promised in the contract into a bundle of goods or services that represent a combined output or output for which the customer has contracted. In other words, the entity using the goods or services as input to produce or deliver the combined output or output specified by the customer. A combined output or output might include more than one phase, element, or unit. One or more of the goods or services significantly modifies or customize, or are significantly modified or customized by one or more of the customer goods or services promised to a contract. And then C, the goods or services are highly interdependent or highly interrelated. In other words, each of the goods or services is significantly affected by one or more of the other goods or services in the contract. For example, in some cases, two or more goods or services are significantly affected by each other because of the entity will not be able to fulfill its promise by transferring each of the goods or services independently. So those are the indicators that the product is not separately identifiable. And then we're looking at paragraph 30. If a promised goods or service is not distinct, an entity shall combine that goods or services with other promised goods or service until it identifies a bundle of goods or service that is distinct. In some cases, that will result in entity accounting for all products or service promised in a contract as a single performance obligation. So once the identification has been made that the product promised to the customers is not a separate identifiable item, then it should be considered as a single performance obligation in determining the price. The anticipation of the performance obligation. So when does the entity certify the performance obligation? An entity shall recognize revenue when or as the entity satisfies the performance obligation by transferring a promised goods or services that is an asset to a customer. An asset is transferred when the customer obtains control of that asset. So it is important to take note that an asset is transferred when the customer obtains control of the asset. For each performance obligation identified in accordance with the paragraph 20 to 30, an entity shall determine a contract's inception whether it satisfies the performance obligation over time in accordance with paragraph 35 to 37, or satisfy the performance obligation at the point in which, in accordance with paragraph 38, If an entity does not satisfy a performance obligation over time, the performance obligation is satisfied at the point in time. Candidates, it is very important that you understand when the performance obligation is satisfied. It could be satisfied at a point in time, or it could be satisfied over the period of time. So, for example, when it comes to delivering of products, as soon as the customer sign the delivery note at the point in time, then the performance obligation has been satisfied. However, if you're talking about the data and airtime that is provided over a period of 36 months, then that one it is satisfied over time. As the data is consumed, then the customer is being charged for the data that is being used. So it's very, very important that you understand the difference and differentiate the at a point in time and over time. Goods and services are assets, even only monetarily, when they are received or used. As in the case of many services, control of an asset refers to the ability to direct the use of and obtain substantially all the remaining benefits from the asset. Control includes the ability to prevent other entities from directing the use of and obtaining the benefits from an asset. The benefits of an asset are the potential cash flows, inflows, or savings and outflows that can be obtained directly or indirectly in many ways, such as using the asset to produce goods or services, including the public services, using the asset to enhance the value of the asset, and using the asset to settle liability and reduce expense, selling or exchanging the assets, pledging the asset to a secure loan, and holding the asset. And then when we're looking at paragraph 34, when evaluating whether a customer obtained control of an asset, an entity shall consider an agreement to replace the asset. And then paragraph 35, performance obligation satisfied over time. Now we will look in detail in terms of performance obligation satisfied over time. What are we talking about in that instance? An entity transfers control of goods or services over time and therefore satisfies the performance obligation and recognizes revenue over time if one of the following criteria are met. So it means any one of the following criteria need to be met to confirm that this performance obligation is satisfied over time. The customer simultaneously receive and consume the benefits provided by the entity performance and as the entity performs, right? So there's a simultaneously consumption and the delivery. So as the entity delivers the service or product, then on the other side, the customer is simultaneously consuming it. That could be an example of the airtime. The entity performance creates or enhances the asset, for example, work in progress, there's the customer control as the asset is created or enhanced. And the examples work in progress. The entity performance does not create an asset with an alternative use to the entity, and the entity has an enforceable right to payment for the performance completed to date. And in paragraph 36, what are we talking about? An asset created by an entity's performance obligation do not have an alternative use to an entity if the entity is either restricted contractually from readily directing the asset from the asset for another use during the creation or enhancement of that asset, or limited practical from readily directing the asset in the completed state for another use. The assessment of whether an asset has an alternative use to an entity is made at contract inception. After contract inception, an entity shall not update the assessment of the alternative use of the assets unless the parties to a contract approve a contract modification that could substantially changes the performance obligation. Paragraph B6 to B8 provide guidance for assessing whether an asset has an alternative use to an entity. And then paragraph 37, an entity shall consider the terms of the contract as well as any laws that apply to the contract when evaluating whether it has an enforceable right to payments for the performance completed to date in accordance with the paragraph 35C. The right of payment for performance completed to date does not need to be fixed amount. However, at all times throughout the duration of the contract, the entity must be entitled to an amount that at least compensate the entity to performance completed to date in the contract is terminated by customer or another party for reason other than the entity its failure to perform a promised as promised rather. Paragraph B9 to better then provide guidance for assessing the existence of enforceability of the right to performance to payment and payment an entity's right to payment would entitle the entity to be paid for its performance completed to date. Performance obligation satisfied at a point in time. So we know that there's a performance obligation satisfied over time, which we have covered. Now there is a performance obligation satisfied at the point in time. If the performance obligation is not satisfied over time in accordance with paragraph 35 to 37, the entity satisfies the performance obligation at a point in time. To determine the point in time at which the customer obtained control of the promised asset and the entity satisfies performance obligation, the entity shall consider the requirements for control in paragraph 31 to 34 in addition, as the entity shall consider indicators of the transfer of goods which include but not limited to the following. The entity has a present right to payment for the asset if the customer is presently obliged to pay for an asset. When that then that may indicate that the customer has obtained the ability to direct the use of and obtain substantially all the remaining benefits from the asset in exchange. The customer has legal right to the asset. Legal title may indicate which party to contract has the ability to direct the use of and obtain substantially all of the remaining benefits from the asset or restrict their access to other entities to those benefits. Therefore, the transfer of legal right of an asset may indicate that the customer has obtained control of an asset. If an entity remains legal titled solely as a protection against the customer failure to pay, those rights of the entity would not preclude the customer from obtaining control of an asset. C. The entity has transferred physical possession of the asset. The customer physical possession of an asset may indicate that the customer has the ability to direct the use of and obtain substantially all of the remaining benefits from the asset or to restrict the customer from other entities to those benefits. However, physical possession may not coincide with control of an asset. For example, if those repurchase agreement and in some consignment agreement, a customer or consignee may have physical possession of an asset that entity controls. Conversely, in some bill and hold arrangement, the entity may have physical possession of an asset that the customer controls. And we look in paragraph B64 to B76, B77 to B78, B79 to B82 provide guidance on accounting for repurchase agreement, consignment arrangement, and bill and hold arrangement, respectively. The customer has the secondary rights and reward of ownership of the asset. The transfer of the secondary rights and reward of ownership of the asset to the customer may indicate that the customer has obtained the ability to direct the use of and obtain substantially all of the remaining benefit from the asset. However, when evaluating the risk and reward of ownership of a promised asset, an entity shall exclude any risk that give rise to separate performance obligation in addition to performance obligation to transfer the asset. For example, the entity may have transferred control of an asset to the customer but not yet satisfied the additional performance obligation to provide maintenance service related to the transfer of goods or asset. E. A customer has accepted the assets. The customer acceptance of an asset may indicate that it has obtained the ability to direct the use of and obtain substantially all the remaining benefits from the asset. To evaluate the effects of the contractual customer acceptance clause on when control of an asset is transferred, an entity shall consider the guidance in paragraph B83 and B86. Then measuring progress towards complete satisfaction of a performance obligation. 39. For each performance obligation satisfied over time in accordance with paragraph 35 to 37, an entity shall recognize revenue over time by measuring the progress towards complete satisfaction of the performance obligation. The objective when measuring progress is to predict the entity's performance in transferring control of goods or services promised to a contract, that is, the satisfaction of the performance obligation. An entity shall apply a single method of measuring progress to each performance obligation satisfied over time, and the entity shall apply that method consistently to similar performance obligation and the similar circumstances. At the end of each performing period, an entity shall remeasure in progress toward complete satisfaction of performance obligation satisfied over time. Method for measuring progress. Appropriate method for measuring progress include output methods and input method. Paragraph B14 to 19 provide guidance for using output method and input method to measure entities' progress towards complete satisfaction of the performance obligation. In determining the appropriate method for measuring progress, an entity shall consider the nature of the goods or services that the entity promised to transfer to the customer. When applying the method of measuring progress, an entity shall exclude from the measurement of process any goods or services for which the entity does not transfer control to customer. Conversely, an entity shall include in the measure of progress any goods or services for which the entity does not transfer control to a customer when satisfying the performance obligation. And then in circumstances change over time, an entity shall update the measure of progress to reflect the changes in the outcome of its obligation. So that changes to the entity measures to progress shall be accounted for as a change in accounting estimate in line with International Accounting Standard 8. Reasonable measurement of progress. An entity shall recognize revenue for the performance obligation satisfied over time only if the entity can reasonably measure its progress towards complete satisfaction of the performance obligation. An entity would not be able to reasonably measure its progress towards complete satisfaction of the performance obligation if it lacks reliable information that will be required to apply appropriate method to measurement progress. In some circumstances, for example, in the early stages of the contract, an entity may not be able to reasonably measure the output of the performance obligation, but the entity expects to recover the cost incurred in satisfying the performance obligation. In those circumstances, the entity shall recognize revenue only to the extent that the cost incurred until such time that it can be reasonably measured the outcome of performance obligation. Now, we're going to stop here, and then on the next class we'll start from measurement. That means we'll start from paragraph 46. Thank you so much. If you're not following me on TikTok as well as on the red page, please follow me. My details is economics 199 with the South African flag. All the best as you are preparing for your exam. Either you're preparing for your degree, you're preparing for CCA, or you're preparing for any course that requires IFRS 15 understanding. Thank you so much.